See how she goes. Hey, Sean, how are you?
Oh, how you doing today?
What's going on?
Is it just us?
So far, you're gonna get some one-on-one if
That's
nobody
all
else
right.
here in a couple of minutes.
That's personal service there. I'll be back in 1 second. I just got right downstairs real quick.
Take your time.
I'm not leaving you.
You got it. Hey, Anthony, we're gonna get started here in a couple of minutes. Just give some people a little bit more time.
All right, no problem. How's it going today?
Good. How are you?
All right, I'm doing well. Thanks for asking.
Sean, that's a Ron Jaworski poster I see in the background. Is that what I'm looking at?
You talking about me?
No, I was talking to Sean.
Oh,
Yeah, that's
okay.
Jaws. Got Reggie
Very
White
nice.
on the other wall. You can see him.
Oh, there you go. Very cool. A little bit more old school of the guys. Doug McGraw.
Carlton.
Very cool.
Yeah.
Carlton, yeah.
And Roy Halladay
yeah,
is the
nice.
other one. And that was from that perfect game back in 2010, I think.
Nice. I got my own share of signed memorabilia back there.
Oh, nice. That's awesome.
All Hall of Famers. Well, and Pete Rose, it doesn't really count as a Hall of Famer, but to me, he someday.
But he
might
should.
be.
Hopefully someday.
Someday. Let's see. So yeah, let's just give another minute or two, and then if it's just the two of you, we'll run through it rather quickly and go through some questions and answers. I don't know, but if you guys have ran into anything so far, just to kind of bring it up and let. But I'll run over some of the basics with you guys, and then just leave it up for some questions and answers.
Okay.
I don't know if I can even adjust my screen, but I got Reggie Jackson,
Nice.
we got Mickey Mantle,
yeah.
Dick Snyder, Willie Mays,
Wow,
and then Cal Ripken over there.
that's awesome.
And then
Man.
yes, all Hall of Fame baseball players and bats. And then over here I got, I can't see it, but it's Muhammad Ali, Joe Frazier, signed gloves, and
Oh wow.
some a little bit in that sports memorabilia too.
Yeah, you got your own museum in there, huh?
Yeah, when I was a little kid, I used to collect a lot
That's
more.
cool. Yeah.
So now I just
That's
get
awesome,
to hang it
man.
up. All right, so let's get started here. Joan's joining us. Give her a second. Hey there, Joan. All right, so there's only a couple of you here, so it'll be more personal, hopefully, with some situations that you guys have going on. I'll just give you some general background on me. I've been doing this about 20 years now. Started off as a mortgage processor, what feels like 100 years ago at PHH, also known as Sendant. Was there for years. Went to GMAC financing, then got more into sales, left the processing and underwriting world, and have been doing sales ever since. I guess the advantage of that is when I look at a deal, I'm not one to yes people to death. I am going to look at it from an underwriter processing perspective. And my goal is to try and let you know as much upfront and make sure your borrower qualifies, rather than these nightmares you see where people go through this process and go all the way to almost the closing table and then the deals fall apart. That is never what you want to see happen. Even with the best loan officers, the only reason that should be happening, and does happen, if someone loses their job right before closing. But way too many times what we see are people go all the way through closing and then get stopped. And the reason a deal dies is something that they should have seen day one of the pre-qualification. So, whether it's me, it's just always good to work with somebody you trust, you have experience with. People go online, they call a call center, they get a pre-qualification letter, and that person's been in the business a couple weeks and has no idea what they're looking at. If you talk to anyone in real estate that has been doing this a while, they've all seen this happen, and they always come to me or someone else when it's too late. So, use people you trust in the business for everything. The more you can control, the more confident you're going to be with what's going on out there. So, that's sort of the advantage. Also, a lot of these national companies out there don't know about the local programs, the state bond programs, or they might not participate in USDA. With us, we offer all those things: USDA, VA, FHA. So it's always good to know what your lender offers, because you keep sending them clients, they don't offer key programs, they're limiting your business in the long run. So they're very important. I hate to start off with this as well, but I do want you to know what's going on in the market. Unfortunately, over the past couple of weeks, we've seen a huge increase in interest rates. Of course, they're still historically low. Of course, if you buy a house and you can get these rates, it's fantastic. But just a couple of weeks ago on a 30-year fixed, we were in the mid twos, and today we're closer to the low threes. So conventionals like floating around on a 30-year about 3.25, 3.125, on a 15-year about 2.5. FHA, same thing, about 3.25, VA, USDA, and 3.25. Although it sounds awesome to a lot of people out there, they're miserable because rates have gone up from the numbers, the crazy numbers they've heard in the past. So they are starting to go up. The reason they're going up is, I guess, two things: inflation, and we were an all-time low in confidence level, sort of in the center of COVID. Now that we're moving out of COVID, the comfort level is sort of easing up, and therefore rates are starting to tick up a little bit. So, but just to let you know, 3.25 historically is about as low as they've been if you take out the. It's still tremendous interest rates, but we see a tick upwards. You don't always see that on TV because all these mortgage companies are still advertising, hey, rates are the lowest ever. Well, historically, yes, but compared to a year ago, really. So just keep that in mind. I'm going to stop here and see if you guys have any questions, because I can't listen to myself talk for that long. Any questions?
No, I'm good. I'm good so far.
So anything about rates? No, good?
Could you explain USDA a little bit more?
Sure. So that's one of my topics coming up, so I'll just do it now. So even before I get there, when I qualify somebody, I'm always looking at all options, especially in this market. So it might be best for your borrower to go USDA, which I'll explain in a second, but they might have a better chance of getting an offer accepted by going conventional. It's a very competitive market. Sellers always want to take their best option. If that is conventional, that's what we want to put out there. So when I pre-qualify somebody, the best for them might be FHA, so they might get a better rate. If they go conventional or USDA, maybe the rate's a little bit higher, but there might be less of a chance of getting a USDA or FHA. So maybe for them in their best interest, even though it's a higher rate, is to go conventional. So when we're looking, we're trying to qualify them for a multiple of programs, sort of go with whatever best their needs, which means could be getting into the house or giving them a lower payment. So you have conventional, which is mostly better credit, more money down. You have VA, which you can do 100% financing and means you're a veteran. So military, and we get a certificate of eligibility. You have FHA, which is usually worse credit, lower credit and less money down. You would go FHA, and then you have USDA. So USDA is for people in rural areas. And there's a lot of that in South Jersey. The only way to find out is you can physically type in the address on USDA's website. If you type in USDA map, it'll tell you to type in the address and it'll tell you it's USDA eligible. If it is, you can do 100% financing on that home. So the advantage is 100% financing. It's a low interest rate. The income limit's right around 111,000. So the household income has to be under 111, which is still pretty aggressive. And instead of having FHA mortgage insurance, they have their own fee, which is much smaller. It's about half of what you'd pay on FHA for mortgage insurance. So you get lower mortgage insurance, 100% financing, but it's in rural areas. This goes back to pre-qualification. So if you send me a borrower and I pre-qualify them, I want to pre-qualify them. Typically, maybe it's an FHA because they want to put a little bit of money down. So we qualify them FHA. Then you come back to me and say, Mitch, we just found this house. It's in Chemung. What do they qualify for? So we type it in the map and say, look, we can still go FHA, or we can go USDA because they meet the income qualifications. Or if you know they need 100% financing, you might just only want to look at USDA areas. So you pull up the map even before you take them out, pull up the areas that they qualify for, look at houses that are available in those areas and just show them. Because if you think about it, if you buy a $200,000 house, you can do 100% financing, and then you need about $7,000 or $8,000 for closing costs. You can ask the seller for those closing costs. They're getting into that house for virtually no money out of pocket. They do need an appraisal fee, a home inspection, but virtually very little out of pocket on a USDA home. So hopefully that answers your question on USDA, what it is, how it works. The map online, USDA eligibility map is fantastic. So I definitely suggest if you want to go USDA, play with that map a little bit and get used to it. Because you can also type in their estimated income and it'll break down the income. It gives you a whole thing, like what's their base income, what's their commission, and you can guide your client to it. And it tells them that they qualify or don't qualify.
Mitch, does other programs besides USDA loans have 100% financing available as well? Like
One is VA.
Oh, just VA. That's it. Okay, yeah, VA is no money down. Okay.
So when you go conventional, 3% down is a minimum for first-time home buyers, or else it becomes 5%. Okay. And then FHA is 3.5% down.
Yep. Okay. All right.
So there are other grant programs. New Jersey HMFA gives people $10,000, and that's done in conjunction with a USDA, a VA, or an FHA loan. So you can do FHA, VA, USDA, and the government will give you $10,000 as long as you have a 620 or better credit score. As long as you make $140,000 household income, as long as you don't have 2% of your own money sitting in the bank.
Okay.
They will give you $10,000. So if you think about it, on a USDA loan, with them giving you $10,000, that's 100% of your closing costs. You're going to take whatever's left over and apply it towards principal. So you're going to actually have equity even though you really don't need it. So we might put 2% down on a USDA loan using the grant program. So
Mm,
that's another tool, sort of low down payment, low closing costs.
okay.
And I want to give you an example of why, something like that is so valuable. Let's just go with FHA because it's probably the most common for your first time home buyers out there. Someone wants a $200,000 home. They would typically need 3.5% down. So that's $7,000. And then they would need closing costs and prepaids. Closing costs are like your one-time fees, your home inspection, your appraisal fee, the title work. And then the prepaids is you have to prepay a year's worth of insurance, about 5 months worth of taxes. So when you buy a home, you really need your down payment, plus you might use an attorney, you might get a survey. So all those things could cost you $9,000, $10,000. So with an FHA loan, let's just say those costs are $9,000, your down payment is $7,000. That is $16,000. So now you're getting 10 if you use a grant program. So now you only need 6. If you get the seller to contribute towards costs and they give you 5,000, now your borrower only needs 1,000. So using seller concessions, using these grant programs can take someone from needing 16,000 down to 6,000 or down to just $1,000. And the same thing, if you do it with a VA or USDA loan where you're getting 100% financing, then you virtually need no money out of pocket. You still need to pay some cost up front, like your earnest money deposit, your appraisal fee, home inspection. But I tell people about $2,000 with VA and USDA is all you really need. So, and look, there's other grant programs. There's grant programs through different counties, all over the place. So
Mitch.
Yep.
As you know, we've been working with a buyer and they're FHA approved, but FHA is not popular with most sellers. And we've lost many of them because we're FHA. Is there anything else we could do to boost up that buyer?
So specifically, I'd have to go back and look at it. But when I do pre-qualify people, I do tell them, like, this is your best scenario, FHA, but it might not be the best scenario for you to put out there. So typically when I do tell them, they can also go conventional, but their payment's a little bit higher. But in this market, we need to have those options. So in your specific case, let me go back and double check it. I think we might have been restricted, but I will double check and let you know. Because yes, if we can go conventional, if their payment is going to be slightly higher, if they're not getting offers accepted in the markets they're looking at, it's not really doing them any good.
No, and nobody's
And-
taking seller concessions either. They're just taking the highest bid and higher and higher bid. And what is it that the seller dislikes the most about the FHA?
So excellent question. So the sellers are told that the appraisals are much more difficult on an FHA program than a regular conventional program. On top of that, historically, conventional has been, when you say conventional, you typically need better credit, and it's typically a sign you're putting more money down. So when they hear conventional, they automatically think they have a buyer with better credit and more money down, so less can go wrong in this market. Also, conventional, they think a conventional appraisal will approve everything. It's not true. An appraisal, they're not that much different. A conventional appraisal, the house still has to be in safe and livable condition. The difference is when you do an FHA appraisal, it follows the house for a long time. So you do a conventional appraisal and it comes in low, they'll just move on to somebody else. If you do an FHA appraisal and it comes in low and those people walk away, the next people that come along have to use that same appraisal. So that appraisal follows the property. So if it calls for repairs, if the value is low, the owner is now stuck with that appraisal. So that's where FHA is a little bit more frowned upon than conventional.
Especially
And
if they say sold as is, but it
yes.
can't be. Can't
Yeah,
be
look,
because
every
they,
house is listed in the contract. It says sold as is, but there truly is no such thing. You could put it out there and say it's sold as is, but if the appraisal comes back and says this switch isn't working or this is failing, in order for you to be able to sell that house, that has to be fixed. So either the seller can fix it, the buyer can fix it, but no one can buy their house until that is fixed. And
and it has to be fixed before they buy it.
it has to be fixed before they buy it. So
What
that
if the buyer,
appraiser,
what if the buyer says, well, I'll just fix it later? They won't approve that? No?
so not if the appraiser calls for it. If the appraiser calls for it, the appraiser is saying, in order for us to be able to close on this transaction as an FHA, conventional, VA, USDA, whatever it is, in order for you to be able to close on this, these items have to be fixed beforehand. So they have to be fixed. We're going to send out an inspector to do a final inspection and make sure those items are fixed, and you can't close until they're done. So here's what I will tell you. If it's something minor, like let's say it has a missing piece of wood of a railing, and that's a $20 fix, and the sellers aren't willing to do it, go to the house and put up a railing, send out the inspector, and you're fine. But if you're paying for major repairs and that deal falls through, you just paid to fix someone else's house.
Yeah.
So you got to be very careful telling your sellers, your buyers, to do any type of work on a house that they don't own. You're always better off having the sellers try and do it and working something out, because if it's called for, it has to be done. No ifs, ands, or buts. So we have to send an inspector out to confirm it's done, or the appraiser. So sometimes it'll say, hole to be fixed, need re-inspection. And then the appraiser just needs to go back out there. Sometimes it'll say, there's a hole in the ceiling, need a professional to tell you it's not, there's no leak, and repair is not structural. Well, now you need a plumber, maybe a structural cert, depending on what the appraiser asks for, is going to tell us who can fix it, what they're looking for to complete it. So all that can have a major effect on what needs to be done. A small hole, if the appraiser thinks it could be a leak, they're going to ask for a certified plumber to go out there and report that there's no longer a leak, and then that the hole was repaired and fixed. Make sense?
Yeah, so your pre-qual says FHA / conventional, or it has to be either or?
I only put one on there at a time, and then I will adjust it,
Okay,
because you could put multiple on there, but that always leads into issues if someone decides to go FHA and puts an FHA offer on, and then it comes back, it doesn't work, and now they say you're forced to go conventional, and you don't want to put that out there. So
okay,
we only do one or the other to match your offer you're going to put in particularly.
okay.
Okay.
Okay, we're gonna try it again. We keep trying it every week.
And I'll take a look at the one we talked about
Yeah,
again.
I
I think we're
appreciate it.
limited to FHA, but I'll double check just
all
to
right.
put another set of eyes on it. So guys, I sort of talked about the differences between VA, USDA, conventional, FHA. Some of the other differences are the amount of seller contribution. So the amount of money a seller can contribute towards a transaction. Once again, we talked about it's a little bit difficult in this market, but when this market calms down, it's huge. On the conventional side, if someone's putting down under 10%, they can get 3% from the sellers. FHA, they can get 6%. USDA, they can get 6%. And VA, they can get 4%. On the conventional side, it's sort of a moot point, but if they put down 10 to 20%, they can get 6, and more than 25%, they can get 9. But if they're putting 25% down, they really don't need the seller concession most likely at that point anyway. There's also limits, like if you do a conventional loan, the loan limit is like 500, just under 550,000. It's 548. So if someone wants more money than that, it goes to jumbo financing. FHA has limits about $430,000. So if you want to buy a single family unit, and these are single family numbers, they go back up for multi, and someone wants to borrow 500,000 and go FHA in this area, they can't, or we'd have to go conventional or some other option. USDA, we talked about the income limit, that's about 111,000, and VA pretty much got rid of all their limits. So we're talking about Joan about too was how would you qualify? Why would you go FHA versus conventional? So FHA, you get pretty much the same rate no matter what your credit is. There's some slight changes, but if you're 620, you're going to end with about 3.25, whether you're a 620 or a 780. On the conventional side, you can go conventional with a 620 or better, but your interest is going to be horrible that low credit score. So your conventional rates are driven by credit score. So if you have a 780 or better, you're going to get that best rate out there. You're going to get that 3.25, 3.125. But now if it goes down to 740, 720, 700, 680, every 10 or 20 points, that interest rate is going up. So in a conventional, we can go conventional, but you might be at 4.5%. So that's the big difference between going conventional and FHA. So your 640 credit score, I'm telling you the best option is FHA, because the other thing that drives is your mortgage insurance. Mortgage insurance is that premium you pay when you don't put 20% down. On conventional, that's also driven by credit score. So you might be at 4.5, and your mortgage insurance might be double what it would be on an FHA loan. But if you have a 780 credit score, then the interest rate's lower, and mortgage insurance can be lower than an FHA loan. So those are the different things we're looking at in different scales, and why I tell you when we look at them initially, what's best for them, what's best for the market. When they find a house, we look at it again to sort of determine what makes the most sense at that point. And that's really what you want your lenders to do. And you might be calling the lender and they only offer conventional loans. So they're not looking at USDA, VA, because all they do is, it's a credit union and all they do is vanilla conventional loans. So they tell your borrower, oh, you don't qualify conventional, and they think they don't qualify. Little do they know that, look, there's 20 other options available to them out there. So that's why we're looking at all these things. That's sort of why we choose different programs. I'll stop again. Any questions?
Thank you.
Oh, we're good right now.
Good, good, and good. Sorry.
What's the minimums right now for a credit score to get approved?
So every lender's, every lender's a little bit different on that. Right now on an FHA program, we go down to 580. And that's sort of the minimum for most lenders. If you're in a 580 range though, instead of putting 3.5% down, they're going to make you put like 10% down on an FHA loan. So there are options, but they're not wonderful.
Yeah.
Really, that sort of plateau is 620 to get the state program, to get VA, USDA, to get in the sort of normal range of FHA. We want a 620 or above. There's still a lot of lenders with COVID at 640 though.
Okay.
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 So
you.
once again, though, that changes with what rate you're going to get with the different conventional programs and everything else as well. So I talked about sort of rates going up because of the market and the bonds, pre-qualifications we talked about for, I'm just going through my notes. We pre-qualify for different options. Calculating the payment, we really didn't go over yet. Condos, I'll go over very quickly. All right, so it's always good in your head to calculate a payment. And I love giving people this simple formula to qualify. If you have a borrower and they tell you, hey, Mitch, I make $12,000 a year, I want to buy a $400,000 house. I know it doesn't sound right, but how do you sort of figure out what someone qualifies? I like going with their half of their monthly income sort of rule. So if someone makes $60,000 and you divide that on a monthly basis, divide it by 12, that's $5,000 a month. You got to get their monthly gross income. So, just divide what, if they tell you their salary, divide it by 12. They make $120,000 a year, that's $10,000 a month. They make 60, that's $5,000 a month. So once you have that between all their debt and their housing payment, they can qualify for 50%. So at 60,000, let's use that rule. That's $5,000 a month. If you take half, they can qualify for up to $2,500. $2,500 is their magical number. Now they tell you they have a $500 car payment. They have $500 in student loans. Now you got to take $1,000 off that number. So now they qualify for $1,500. They tell you they have 2 credit cards at $100 each. Now they qualify for $1,300. So using that sort of number, so now you know that housing payment has to be under $1,300, let's say, because you have their car payments, student loans, credit cards. Out of that $2,500, that ate up $1,200, that leaves you $1,300. For every $1,000, payments about $450. So if someone's buying, they're paying $450. You take their taxes, you divide it by 12. So if taxes are $6,000 a year, that's $500 a month. So now you know their tax is $500. It's a $2,000 home, so that's $450 rule per 1,000. That's $900. You know you're at $900 and $500. You're already $1,400. Too high, because you're not even counting homeowners insurance. And I typically tell you to estimate about just under 1% for mortgage insurance if you're not putting 20% down. But yeah, I mean, just a rough way. Look, I make $120,000. I got $2,000 in other debt. Okay, so that's $10,000 a month. That's $5,000 you can use. They have $2,000 other debt. You know they're good to go for $3,000 a month. That's a decent size. They can buy a $300,000 home easily. So just using that percent rule is pretty huge. So just to cap, and look, I'm always here, to get exact numbers, to do scenarios. But if you just want sort of a rule of thumb to sort of follow, that's good to go. Condos, I always talk about condos because if it's a condo, you don't own the actual structure, it's owned by the association. And you have condos, you have planned unit developments, they all look the same. Basically, townhome is the architecture, so there's these attached homes. But if you don't own the structure, it's a condo, and your fees are usually $200 plus. If it's a townhome, your fees might be like $60 or $70. You own, you're responsible for your house, you own it, but there's some common areas, maybe a pool or something that you share. So if it's a condo, you need special approval. Not only do we have to approve your client, but we have to make sure the condo is approvable as well. So if you have a client looking at condos, you need to make sure it's an approved FHA condo if you're using an FHA loan. And there's a whole questionnaire, there's a whole process to go through. There's a website for FHA approved condos, but with COVID, a lot of people aren't paying their condo fees. So we have condos that were approved by FHA that say they're approved, but they're no longer approved. say if you have a condo, you want to stop everything, make sure you're good with the condo, call me, ask me, and then move forward, because people are paying for home inspections, paying for appraisal, going through a process, and then we're telling them it's not an FHA approved condo, you just wasted all that money and time. So if it's a condo, talk to your lender, make sure it's okay. We have to go through a major process, but you sort of want to do that ahead of time. And look, people.
Yeah,
being
I had
out
a
there-
condo.
Yeah,
I had a condo, I just sold a condo, and the seller insisted that it was FHA approved. But when it came down to it, it was not. We did all this searching and everything just to find out it was not FHA approved. And they said, it's never FHA here. We're like, then why did he put that in the listing?
Hmm.
Then we couldn't do
Just put it
FHA,
in
we
the
had to go
listing.
conventional. So the seller agent should know this, shouldn't they?
they should ask the questions, but they never ever do. And
He
look,
said,
they
I
might
thought
just,
it was.
they'll even ask the seller and say, hey, how did you buy this? Oh, I used an FHA loan. Well, that was 20 years ago. That doesn't mean it's still approved FHA. So a lot of most condos are not FHA approved. Most people who want to buy a condo are first-time home buyers. They want to use FHA. So it's a big, big challenge to get these things approved, and no one really looks at it hard. So you really have to do your homework, contact the association, see if they've recently been selling them as FHA. And that's the only way, because they'll always say, yes, it's eligible for FHA, it's eligible for conventional, but it typically a lot of times is not.
Not.
So the other thing, a lot of other agents have been coming back to me and their clients don't qualify, even though they were pre-qualified. The way we calculate income and everything that's happened with COVID and people being out of work, people work 40 hours a week, but they were out for 6 months, and they're not guaranteed salaries. All these things are affecting them. So it's just so important to make sure people are going over your client's income correctly. If they were out of work, are they salaried? Are they variable income? All these things are killing deals in the middle of the process. So I can't stress enough to use somebody that knows what they're doing, because they're saying, yeah, I make $40,000 a year, and they're qualifying them based on that. They're going through the process. It's not going to an underwriter to the last minute. And then the underwriter says, hey, yeah, they make 40,000, but they were out of work for 6 months and the company doesn't guarantee them 40,000 and they only made 20,000. Now they don't qualify. It's happening a lot. COVID. Because self-employed borrowers, people that are not salaried employees have huge effects. So all these things are affecting deals. Other thing, and I won't keep you guys much longer, I'll open up for questions. The market's really competitive right now. So how do you find houses for your clients? If a house is in good shape, it goes. It gets listed, there's 30 people lined up to look at it. But if you go after houses that are dilapidated in bad condition, bring your clients to them and say, hey, why don't you do a construction loan? Why don't you take this house? It's got all the bones you're looking for. We'll go in, we'll put an offer for $200,000. You'll do $50,000 worth of work, and you'll end up a house that's worth $350,000 that you pay $250,000 for. So we do construction financing. We get plans and specs. We approve them based on what the house is going to look like. There's an FHA program that allows this. There's conventional programs that allow it. They're called rehab and construction loans. And it opens up a whole market that people aren't looking at. So you have to be creative. Everyone's looking at this house and this house because they're cookie cutter homes. No one's looking at this house over here, make it attractive. How about if we go in, you get your new kitchen, you get your new bedroom, you get your new bathroom, and you're buying it. No one's bidding this property up $50,000 over asking price. they're giving it away. It's been on the market for a year. No one's touching it. Go after those, have people do construction loans. We're seeing more and more construction loans out there than ever. And don't be dissuaded. If you have a borrower that qualifies and the only option is FHA, it is harder, but I'm still writing. I have a lot of conventional loans in my pipeline. I have a lot of still grant loans. I have a lot of FHA loans. So there are people accepting these offers out there as well. Look, if they have a conventional offer and an FHA offer, but the FHA offers for $7,000 more, they're still most likely going to take the FHA deal. So there are ways to get these deals won and accepted. So you just have to be creative, look at all your options, know all your options, and really go from there. I talked way too much, so I'm leaving it up to you guys.
Are you guys currently doing like non-primary resident loans or hard money loans?
So we're not a hard money lender, but excellent question. So we do, if you buy a second home, and a second home is defined as I'm buying a house at the shore in the mountains that I'm going to use, you get the same rate, pretty much the same programs, same amount down that you would for a primary residence. So you can buy a house down the shore, but if you want to buy an investment property, we do those as well. Those have to be in safe and livable condition, and you typically have to put 20 or 25% down to get the best rate. But we do investment financing all the time. It's just if you want to borrow hard money, rehab a house, and flip a house, banks, most mortgage companies don't like that because they don't make any money if it's high risk and no profit, because you're going to sell that house in 2 months, right? So we're going to do all this paperwork and we make money over the life of that loan. So if you buy a house, flip a house, and then sell a house, there are specific hard money lenders out there that are giving you a loan for a very short period of time, charging you very high interest rates in a short period of time, not over a year. And that's where they make their money. So we do investment properties. Yes, if you want to buy an investment property and finance it and rent it out, that's what you come to your normal lender for. But flipping hard money, that's a little bit different. Any
What
other
about
questions?
refinancing on a secondary home?
So you
Do
can
you offer that?
refinance a second home. We can refinance an investment property. We can refinance a primary residence. The only difference is, and even on a primary residence, right now, they're only going up to about 85% of the value. On investment property, they're only up to 75% of the value. So if you own it and you want to pull out 75%, do a cash out refinance or refinance into a lower rate, you can do that. The only difference is with the investment properties, and even on the conventional side, if you're pulling cash out or if it's an investment property, these are all layers of additional risk and the rates are higher. So you're not going to get that 3.25% for doing a cash out on an investment property. You might be at like 4.5% or 4.75%, but historically, to get that on investment property is fantastic because it used to be your 7 or 8%. So if you can pull out money and borrow money on an investment property in the 4s, that's still pretty fantastic.
Yeah. What about short sales? You guys do short sales?
So there's no restriction to that, whether it's a short sale or foreclosure or someone selling a house. The only difference for us is that house has to be in safe and livable condition. So a lot of times short, they go into the house sometimes, or the issues, or there's just minor repairs and the sellers don't have any money to fix them. So we can do them. There's no restrictions. We just hit some bumps in the road when we come across short sales. The other thing is there's different levels of short sales. If it's a non-bank approved short sale, it could take a year, 6 months to get approved. If the bank's already approved it, it could be a very quick process. But yeah, there's no restrictions for short sales other than if you need repairs or there's issues with the house.
Okay,
All right,
thank you.
pleasure. Guys, anything else?
No,
Uh,
that's it for me.
All right, so I don't know if you guys have my contact information. It's always in the office. It's out there. I'm going to give you my cell phone. It's 856-982-5156. Very quick. You can give them my number. You can give them my website. You can give them my email. People can go online. They can talk to me and I'll walk them through the process. Not everyone likes that. Some people just go online. You hear about Rocket Mortgage. We have sort of the same thing where they go online, they type in their information, they hit apply. It can pull in their bank statements or W-2s if they're signed up to certain things, does a verification of employment. So we get a ton of information on an application right off the bat with very little work from them. If they don't do that or choose not to, they can upload their pay stubs, W-2s. It's very convenient. They still have the best of both worlds because they're not being bothered because a lot of people don't want to talk to their loan officer. But at the same time, in the background, I'm reviewing it. I'm going over it with them, with you, making sure we're getting what best suits their needs. Or look, people call me weekends, weekdays. I'm always tell you I'm available 24/7. I always get back to your person. I'll tell you to tell them within 24 hours, but usually I'm calling them within 20 minutes because I don't want to lose that deal. So, refer them, give them my cell phone. You send me a heads up, a text or an email, say, hey, Mitch, I just sent you Bob Smith. This way, some people might not call me for a month. I'll know where it came from. Always try and get me their contact information and I'll reach out to them as well. That's always best because if you give them my number, they'll say, yeah, I'll call, and then they'll never call. So, talking to mortgage guys is like sharing your dirty laundry. Not everyone loves to do it, but we got to get them to us so we can get them back to you approved and ready to go. We don't want you guys wasting your time taking people out looking for houses when they don't even qualify. So that's it, guys. That's all I got. Any questions? I'm here for you. So 24/7, give me a shout, send me a text, whatever you need.
Awesome. Mhm.
All right.
Thank you.
All right, guys. Take care.
See you.